Welcome back to the deep dive. So today we're tackling a fascinating one. Kawasaki Heavy Industries, KHI. Most people probably think motorcycles, right? Ninja bikes.
Mm.
But this company, it's this sprawling Japanese industrial giant. We're talking ships, planes, trains, even robots. It's almost like industrial schizophrenia.
It really is. Trying to get your head around KHI is like looking at maybe 5 different companies all at once. You've got aerospace, then energy and marine, precision machinery and robotics, transportation systems, and yeah, the motorcycles and engines division everyone knows.
So quite the mix.
Exactly. And our goal today, our mission, is to try and cut through some of that complexity. We're digging into their performance, the big structural changes, especially between, say, 2017 and 2024. We want to understand how this traditional heavy industry player is really trying to pivot towards future tech. Think hydrogen, high-tech robotics.
Okay, let's unpack that. Because their core identity, it really is heavy industry, isn't it?
Yeah.
Defense work, those huge rail contracts, LNG carriers, hydraulics.
Absolutely, that's the bedrock. But, managing such a diverse portfolio in today's market, that demands some serious financial discipline.
Right. So what changed?
Well, the really foundational shift we saw was this pivot, this quite hard pivot towards ROIC management, return on invested capital for anyone not familiar.
And this isn't just some accounting buzzword for them.
No, not at all. It signals a really strict focus on efficiency. KHI basically said, look, we're only going after projects where the profit potential clearly outweighs the capital we have tied up in that business.
Okay, so they set a target, a minimum bar.
They did, and very clearly. A minimum hurdle rate for the whole consolidated group, ROIC 8%, that's quite demanding. It's a huge signal, moving away from maybe chasing prestigious but sometimes loss-making mega projects towards really demanding measurable value for every yen they invest.
Makes sense. And I guess the way the company is structured, the governance, that had to change too, to enforce this discipline.
It did, yeah. They shifted to what's called a company with an audit and supervisory committee structure. Now, that might sound like dry corporate jargon, but what it really does is significantly beef up the monitoring power of the non-executive board members.
So more independent oversight.
Precisely. When your operations stretch from, say, North American train projects to building submarines in Japan, you absolutely need that robust, independent oversight. Make sure capital isn't being, wasted.
Okay, but I want to push back a bit here. One of the biggest moves they made around 2021, 2022 was that big organizational split. They spun off Kawasaki motorcycles and engines. That division was often their most recognizable, maybe their most consistently profitable unit. So wait, if you're trying to stabilize the whole ship, why spin off your main cash cow? Doesn't that just leave the core heavy engineering side exposed with all the cyclical, maybe lower margin stuff?
That's a really fair question, and I think internally they debated that too. But KHI's justification was all about autonomy, speed. They spun off the vehicle, the rail business, into Kawasaki Railcar, Inc. And yes, the profitable motorcycle and engine business into Kawasaki Motors Ltd.
But not just selling them off.
No, the idea was to let these units react faster to their specific markets, let them execute their own strategies without getting bogged down by the bureaucracy of a giant conglomerate. And actually, the MC&E unit, Kawasaki Motors, it instantly became a very stable profit engine on its own. And this restructure kind of refocused the main KHI identity around 3 core groups now: lander transport, motion control motor vehicle, and energy solution marine engineering.
Okay, talking about heavy engineering. The risks there are just massive, right? These are multi-billion-dollar projects. What happens when things inevitably go wrong? What was the biggest stumble, the biggest hit they took during this period we're looking at?
Yeah, risk is definitely inherent. We saw 2 major headaches, actually, both highlighting just how volatile these big bespoke contracts can be. The most direct, sort of sharp financial pain came from shipbuilding between about 2017 and 2019. KHI tried to break into this specialized offshore market, building their first ever offshore work vessel, a really complex piece of kit, and, well, that contract got canceled, design issues, costs spiraling.
Ouch. So what did that cancellation cost them? What was the damage?
It was pretty significant. The termination led to staggering special losses of around $13 billion. That's billion with a B. That money was basically written off to cover inventory losses and accounts receivable losses on that project.
13 billion yen. That's a very expensive lesson.
Oh, absolutely. A painful lesson. And you saw them react, shifting resources away from that kind of high-risk, bespoke offshore stuff towards more stable, maybe higher-value programs like their established LNG carriers and, importantly, government defense work.
Right. And you mentioned 2 headaches. What was the other one? The rail business,
Mm.
that seemed to have been a drag for a while, especially in North America.
It certainly has. Yeah, the vehicle segment, the rail segment, it has a history of really volatile returns. I mean, it hit a shocking negative ROIC of 26.4% back in 2018. That was mostly driven by losses on really complex projects. The main ongoing issue, the one they're still wrestling with, is stabilizing that huge North America R211 project. That's for the Long Island Railroad, the LIRR.
Okay, that's a massive contract.
It is. Huge, critical contract for one of the busiest commuter rail systems in the U.S. And there have been delays, persistent delays. It's forced them to cut their profit forecasts for the segment. And now the delivery of the final trains under the base contract is pushed out into the fourth quarter of fiscal 2024.
So it sounds like the game plan in North America, once they finally get R211 delivered, isn't necessarily chasing the next giant railcar order.
Exactly. It seems to be much more about shifting away from that volatile sort of boom-bust cycle of huge new contracts. They're focusing much more on what they call stock-type business.
Stock-type business, meaning?
Meaning things like aftermarket parts, overhauls, and especially maintenance, repair, and overhaul services, or MRO. That kind of work provides much more predictable, often higher margin recurring revenue, steady income.
Okay, let's pivot geographically. We've talked North America. What about their global footprint elsewhere, particularly Asia? That seems like a key area for both heavy industry and the robotics side.
Asia is absolutely critical, yes. On the rail side, you see them very active in big urban infrastructure projects, often financed through Japanese yen loans, things like the Dhaka MRT Line 6 in Bangladesh, and major contracts in Singapore with the Land Transport Authority, LPA.
Okay, and robotics, precision machinery. China must be a huge factor there.
Definitely. And China presents a fascinating kind of complex picture for them. It's a tough market, as you know, especially for things like hydraulics used in construction machinery. Lots of price pressure. They've seen some inventory compression recently.
Right.
But KHI clearly views China as a core mid to long-term market. They're focusing on higher value-added hydraulic systems. And crucially, on the robotics side, they see China as a massive growth opportunity. Why? Because robot penetration there is still relatively low compared to Japan or, say, Germany.
So room to grow.
A lot of room to grow. And to capitalize on that, they just announced in 2024 a new joint venture with a Chinese company, Yantai Edidi. The specific goal is to boost their competitiveness and market share in hydraulic machinery inside China.
Before we jump into their future bets, we have to touch on currency risk. A giant global company like KHI, exporting, importing, they must be incredibly exposed to the yen fluctuating.
Oh, exquisitely sensitive. It's a huge factor. Given the sheer scale of their cross-border business, KHI actually put a number on it. They estimated that just a one change in the US dollar to Japanese yen exchange rate,
Just 1 yen.
just 1 yen, can swing their annual business profit by roughly 4 to 5 billion JPY.
Wow.
Yeah, it depends on the exact period, but that range, 4 to 5 billion yen impact from a single yen move against the dollar. It just shows you why currency hedging and management is this constant high-stakes game for their finance team.
Okay, so that's the present, the recent past. Let's talk about the future. Vision 2030. This sounds less about managing current risks and more about placing some really big bets on entirely new areas. What are the main pillars here?
You're right, this is about growth engines. The three big pillars they talk about are hydrogen, robotics, and underpinning a lot of it, the defense business. Let's start with hydrogen. KHI sees it as absolutely vital, both for energy security for Japan and globally for hitting carbon neutrality targets. And they're not just focusing on one part, they're investing across the whole hydrogen supply chain, producing it, transporting and storing it, and then using it.
And where's their edge? What makes them think they can win in the hydrogen race?
Well, their big historical strength and their current edge is really in transport technology. They are arguably world leaders in developing these very large-scale liquid hydrogen carriers, LH2 carriers. This needs incredibly advanced cryogenic tech, cooling hydrogen down to super low temperature so you can ship it efficiently, like LNG.
Okay, so building the tankers, essentially.
Building the tankers and the related infrastructure, and then on the use side, they're developing things like 100% hydrogen-fired gas turbines for power plants. They're even testing hydrogen engines for ships and, yes, even potentially for motorcycles down the line. They're trying to build the whole ecosystem.
Fascinating. Okay, second pillar, robotics.
Hmm.
What's the focus beyond the typical factory floor robots?
It's kind of a dual focus. Industrially, yes, factory automation is still key, but they're making a huge push into the semiconductor manufacturing market. That's booming. They're targeting $100 billion in sales just from the semiconductor segment by 2030. covering everything from clean room robots for atmospheric handling to new vacuum process robots.
100 billion yen just from semiconductor robotics. That's ambitious.
It is. But the perhaps flashier play, the one getting more attention, is in medical robotics. Specifically, their surgical assistance robot called Hinotori.
Ah, yes, the hinotori. That's been quite visible, a symbol of their shift to high tech. How's that actually progressing? Is it getting traction?
It seems to be, yeah. The numbers are quite impressive, at least domestically in Japan. It's already been used in over 5,000 surgical cases cumulatively across nearly 60 different medical facilities. And crucially, they're now pushing for international expansion. They've got approval in Singapore, and they're actively working through the regulatory processes for Europe and the big prize, the U.S. market.
Okay. Hydrogen robotics. And the third pillar you mentioned was defense. This feels like the steady and, maybe, the reliable part of the business that often gets overshadowed by bikes and bots. How does KHI fit into Japan's current defense planning and buildup?
That's a good way to put it. The steady hand. Defense provides a really important, stable revenue base for them. KHI is a core long-term partner for Japan's Ministry of Defense. They're deeply involved in developing new platforms, things like next-generation submarines, the new C-2 transport plane-based standoff electronic warfare aircraft, quite advanced stuff. And they're also focusing heavily on expanding those MRO services we talked about earlier, maintenance, repair, and overhaul. Not just for trains, but for existing defense platforms and looking ahead for future unmanned systems like UAVs and VTOLs.
So that defense work provides a nice cushion against the ups and downs in commercial shipbuilding or rail projects.
Exactly. It provides necessary stability, predictable government contracts, which helps balance out the cyclical nature of some of their other large-scale commercial businesses.
All right, so we've traced KHI through some major failures like that offshore vessel and these huge strategic shifts, the spin-offs, the ROIC focus. Let's bring it down to the bottom line. How's their financial health looking right now, say, heading into 2024? And critically for anyone watching the stock, what are they actually promising investors in terms of returns, dividends?
Yeah, the financials show a pretty clear V-shaped recovery after those earlier losses and navigating the pandemic disruption. Business profit, which is a key metric for them, it soared from about $303 billion back in 2021 to a projection of $1,300 billion for fiscal 2024. That's billion again, which translates to a forecasted operating margin of around 5.8%. So a significant improvement. It suggests those spin-offs and stabilization efforts are actually bearing fruit.
Okay. Profitable again. What about sharing that with shareholders? What's the dividend policy?
They've been quite clear about this. The stated priority is maintaining a stable dividend payout over time. Their medium to long-term benchmark, the target they've set, is a consolidated dividend payout ratio of 30%.
30% of profits back to shareholders.
Right. And for fiscal year 2024, the expected annual dividend is $140 per share. And that lines up almost perfectly with their target, coming in at a projected 30.1% payout ratio. So it signals, confidence in their earnings and a commitment to rewarding investors, even while they're making these huge capital investments in Vision 2030 in hydrogen and robotics.
So that really brings us to the core tension here, doesn't it? KHI is simultaneously trying to manage the very real risks of its legacy heavy industries, those potential billion-dollar flops in rail or shipbuilding, while placing these massive capital-intensive bets on the high-speed, uncertain future of the hydrogen economy and advanced robotics.
Absolutely. That organizational momentum, the spin-offs we discussed, it shows they can be agile despite their size. It's undeniable. But the sheer scale of this transition they're attempting, it's immense. They're trying to shift from primarily being builders of big physical things, infrastructure, vehicles, to becoming a key player in the digital future and the future of energy.
It's a huge leap.
It is. So the really provocative question, I think, for you listening is this. Considering everything, the geopolitical pressures impacting defense and overseas markets, the technical challenges, can KHI actually pull off this pivot? Can they become a true global leader in, say, the hydrogen economy and surgical robotics? Or will the sheer weight of that cyclical, heavy engineering legacy keep holding them back?
It really feels like a high-stakes bet. Requires near flawless execution over the next 5-10 years.
Keep watching their balance sheet, their ROIC numbers. As you said, that'll tell the story.
Indeed. Well, thank you for walking us through that complex picture. That was our deep dive into Kawasaki Heavy Industries. We'll see you next time.